I'm conscious that some of you may have already heard sort of the Trident Royalties pitch, but I'll cover off our strategy just briefly before I sort of talk about sort of our most recent developments. So the quick summary is we're an AIM-listed mining, royalty, and streaming company, a fairly young company. We've been listed now for about 14 months. When we launched the company, we raised about 20 million US in June last year. We launched with sort of one paying royalty. And since then, we have now built out the 13 royalties, a couple of which are paying, a couple of which are sort of moving towards construction imminently, and we're now sort of closing in or have crossed the 100 million US market cap. So we're seeing liquidity improve as we go. So a sort of fast-moving, fast-growing company. But just taking a step back, for those that aren't too familiar with what royalties are, you're probably familiar with royalties as a financial instrument as it relates to the music industry or film industry. Effectively, it entitles the royalty holder, in this case Trident Royalties, to a percentage of revenue from the underlying asset. So whereas a musician would get sort of a payment as their song is played or CDs are sold, in our case, we get a percentage of revenue from the underlying operations that we have royalties over. So if we've got a royalty over a copper mine, for example, as they're producing and selling copper, we get a percentage of their revenue. And as the copper price goes up, obviously that's a positive for us. Now, where this differs, I suppose, from investing in mining companies directly, is that as a percentage of revenue, we're sitting at sort of the top line of the P&L statement. So we get a percentage of revenue. We're not exposed to cost, to OPEX and CAPEX, whereas in equities, you're exposed to the bottom line of the P&L, to the profit line, effectively. So, for example, if the underlying commodity price goes down, that compresses your profit margin. And for an equity holder in a mining company, you may see no return on that equity if the margins are very tight. Whereas a royalty holder, you obviously don't want to see the underlying commodity price go down, but if it does, you're not exposed to the cost. So if it goes down 10%, the revenue line goes down 10%, all other things being equal. So you don't have that same sort of downside exposure that you do to equities, but you still have the same upside exposure in the sense that if it goes up 10%, you're getting that uplift. On top of that, royalties as financial instruments, they tend to run with the land, which means that they're secured over the property. The operator, in theory, could go bankrupt, and the royalty survives and remains there effectively in perpetuity. And you're still getting that sort of equity style exposure. The reason people invest in mining companies is they want exposure to the underlying commodities, and they also want exposure to the operator, where if they expand the operation, if they are continuing to explore the property and find or expand their deposit, all that is why people invest in mining equities. Well, as a royalty holder, you get the same exposure, because if they expand the deposit, if they expand their production profile, that all still benefits the royalty holder, because at the end of the day, it impacts the revenue line item. So that's royalties as a financial instrument. You'll see here sort of the three of the biggest players in the space, all sort of multi-billion-dollar market cap companies. And these three focus on precious metals, so gold and silver predominantly. And you'll see them sort of benchmarked against the gold miners equities ETF. And what you'll see is all three obviously outperform. And it is effectively because you're getting the benefits of royalties as almost this derivative-like instrument gives you that exposure that I talked about, sort of accelerated type upside exposure with that downside protection. On top of that, mining royalty companies are out there acquiring multiple royalties, so they're very broadly diversified. Whereas a miner operating one or two operations is extremely exposed to sort of single asset risk. So, unsurprisingly, mining royalty companies outperform equities in the space. So I suppose then the natural question is, what's Trident doing different? I mentioned that some of those three I showed on the previous screen are all multi-billion-dollar companies. Where's the gap in the market? In my background, I come from mining private equity, as do all my colleagues in Trident. So for us to sort of leave our previous positions, jump into a startup royalty company was quite a personal risk, and obviously there needed to be a real catalyst for us to do so. And I think that's summarized really on this screen, because what you'll see here is the global mining sector it's pretty broadly diversified, roughly a third precious metals, gold and silver, a third base metals, copper, zinc, nickel, and a third bulks and battery and everything else. So, iron ore, lithium, cobalt, all these sort of commodities. But when you look at the mining royalty sector, it had its birth in North America in precious metals. And what you see today is effectively, of the roughly 70 billion in mining royalty company market cap out there in the world, about 69.2 billion of that is predominantly precious metals focused. And then you've got a couple of big sort of single asset royalty companies, just one royalty, and effectively a passive kind of pass-through instrument. And then you've got a couple that do anything but precious metals, and relatively small relative to the big precious metals players. But what's completely lacking then from the space is if an investor says, yes, I like mining royalties as a way to get exposure to the sector, particularly in an environment like we're in today, where inflation is a major concern. You're seeing that reflected in real assets, in commodities in particular. They are utilized as a hedge against inflation. And we've seen copper over the last 12 months go from sort of $5,500 a ton up to almost $10,000 a ton. Iron ore went from sort of $85 a ton this time last year up to sort of now around $140, $150 a ton. So we're seeing this sort of reflected immediately. Investors say, yes, I want exposure to the mining sector, and I believe royalties are the best way to get that exposure. Well, at the moment, you'd be sort of hard pressed to try to cobble together a representative exposure of the sector. Obviously, you can pick from any number of precious metals royalty companies, but where you'd struggle is to try to flesh out the portfolio to get that full, broadly diversified exposure to the space. And that's what we're effectively building. I mentioned we started with one single iron ore royalty. Since then, we've added gold royalties, copper royalties, and a large lithium royalty. And we're obviously looking to continue to expand. We've done 8 transactions over 13 royalties in the sort of 14 months since we've been listed. So looking to aggressively expand that portfolio to provide that broad, diversified exposure that investors are looking for. Now, I've put the full slide pack in here because it will be distributed, as Chris said, but I won't go through every single slide, just given the time constraint. But one thing I do want to mention is, and this model has been proven over and over by the precious metals peers, is that you start out with one royalty, and as you continue to aggregate assets, whether you're writing new royalties or buying sort of secondary royalties that are already held by anybody from family offices to miners that have sold a property and kept a royalty, as you bring those together into the royalty company, it allows you to do things like start to tap into leverage to continue to expand the portfolio. We've drawn on our first debt piece, and now that we've got some cash flow to support that, and we look to continue to expand that while also reducing the cost as we continue to grow. You can use your listed equity to acquire these sort of existing third-party royalties, and ultimately what you want to do is build out a broad, diversified portfolio and initiate a dividend, and then start to let that cash flow through. And what you can see on this chart is, and again, this is some of our precious metals peers because we don't really have a direct analog on the diversified side, but of these 4, which were sort of recent success stories, you can see on the x-axis days since the inception of their royalty strategy. And as they're aggregating these assets, you see the share price reflecting that. You can see us, the yellow line, we're sort of 14 months in, where we've seen our share price. We listed at 20p. We're sort of ended today at 38p. So we're seeing it reflecting that uptick as we're adding assets. But really the inflection point comes down the track as we continue to bulk out and we get to do things like tap into lower cost leverage, do a dual listing if it's creative, and I think most importantly, initiating a dividend. And that's where you see the share price really start to zip up. That said, we've been happy with our performance to date, as you can see on this chart. As we're adding assets, the market's taking note. The share price moves, which is encouraging, and very importantly, you can see in the yellow bars there, our liquidity is improving as well. So you need to be able to get in and out of the stock as you want to, and we've got good sort of market liquidity in it, and it's improving with every week. So I will jump down to just briefly touch on some of our assets, and in particular, I wanted to spend a bit of time on our most recent acquisition, which we announced last week. But what you can see on this slide is we do have a smattering of assets across various commodities and across various jurisdictions, which is a bit of a difference if you're looking at getting exposure to the mining sector, and you're looking in particular at sort of the junior or mid-tier sector, where you can get sort of that really accelerated growth in share price. what you tend to find is the miners have, 1, 2, maybe 3 or 4 operations, and you're sort of highly exposed to those operations. So, a, a wall failure at the operation, or an employee strike, these kind of things can cripple a share price. Whereas a royalty company with a broadly diversified portfolio, you start to mitigate that risk. And in particular, as we continue to add to the portfolio, you get less and less of that sort of single asset exposure. So just I'd like to touch on our biggest royalty to date, and then our most recent royalty. Our biggest is by far the Thacker Pass lithium royalty. To put in perspective, we bought this royalty for $28 million. Based on the operator's most recent technical study, it should pay back about $340 million over the life of the asset. It's a nice 46-year mine life. The life of the mine is based on the reserve. The resource is twice the size of the reserve, so ample opportunity to expand the production profile or extend the life beyond the 46 years. And lithium, when we did this transaction earlier this year, was about $11,000 per ton. It has now ticked above $18,000 per ton. And the U.S. in particular, a big auto manufacturer, has no real domestic source of supply of lithium. This is the only major permitted project. It's going through its final challenges now to the permit. They expect those to be those will be resolved by the end of the year, and then the operator of the asset anticipates commencing construction in February. So we're soon to have online a lithium royalty that would be paying on average about $7 million a year, acquired for $28 million, and a nice long life exposure to, I think, a pretty key critical metal that feeds into sort of EVs and this sort of green revolution in a tier 1 jurisdiction. It's the kind of royalty you really do want to get. So we're really pleased to get that. And then just jumping down, because I want to save some time for questions, but jumping down then to our most recent acquisition, which was the Lincoln Gold royalty. This was a much smaller transaction. I think it underscores what we're doing slightly differently is our peers are much bigger and they're looking for sort of $100 million plus transactions. Thacker Pass was $28 million. It was sizable, particularly for us. The Lincoln Gold royalty was $2.5 million. And again, it's one of these opportunities that gets overlooked by our peers, but a very accretive opportunity. Effectively, what we had here was an operation in California in the US. It's an underground mine with a good resource. In particular, the exploration potential is pretty astounding. We've run this one through the ringer with multiple geologists and consultants, and sort of had a unanimous opinion that there could be many multiples of the existing resource. So you can see how the asset could expand its life. And again, that all accrues to the royalty and is not priced in on the economics as we did the deal. We can only do economics on what we see immediately in front of us. But being aware that there's this sort of potential upside, that's what you want to see in a royalty. The other element is this was a operation that previously ran. It shut down for a couple of reasons. One is it was over levered. It had about 40 million in debt that it was servicing when it attempted to commence production previously. And also the gold price was about $700 lower at the time. So between the debt service support and the gold price, you're sort of adding about $900 per ounce margin back into this project that it didn't have on its previous attempt. So what we had is a private company that had picked up the project. They put a lot of capital into it. And as a private company, don't have as good access to capital markets, couldn't go out there and raise equity quite as easily, and needed the last $2.5 million to effectively turn it on. The plant's been refurbished, the mine's ready to go, and needed that last bit of capital, which we provided. So they'll be commencing production this year, anticipating hopefully first gold before the end of the year. If not before the end of the year, then in sort of January, but production will commence this year certainly. And so what we have here is what's going to be a nice, good paying gold royalty in a tier 1 jurisdiction, coupled with excellent upside on the exploration front, which could mean that this thing could expand from the initial target of sort of 20 to 25,000 ounces a year of production up to supporting 100,000 ounces a year of production for a very long mine life. And there's quite a bit of information on the operator's website, Seduli, and I'll be doing a subsequent interview with their MD, hopefully here in the next week or two, that we'll be getting out there that will delve into this asset a bit more. But hopefully for people that aren't familiar with the space, this gives you a flavor of both what royalties are, as well as how it can give you exposure to the sector and the type of exposure that we're providing, which I think is a bit unique relative to most of our peers. So with that, Chris, I'll turn it over to questions.
Okay, one of the first questions was, what is your dividend policy going to be over the next 12 months? Can you just elaborate a bit more about what you're expecting?
Yeah, sure. Yeah, so the plan is, and this is a bit of a soft target, so it's not set in stone because it's obviously going to be
Yeah.
dependent on the deals that we do. But we're sort of projecting, and I'll flip down to our revenue slide. So that this is a broker consensus forecast of our revenue. You can
Hmm.
see as assets like Pass and others turn on, our revenue starts to tick up aggressively. And when we get to sort of that 8 to 10 million in consistent annual revenue, that's the point at which I think we're comfortable turning on a dividend because you can service the debt that you have, you can cover your G&A, and you're not really impacting your ability to do subsequent deals if you let some of that capital flow through in the form of a dividend. So really, my job then is to try to continue to add assets like the Seduli Gold or the Lincoln Gold project because it adds to that immediate cash flow, and that's our priority. That's what we're working on now. We mentioned in our most recent announcement that we've got exclusivity over a couple producing royalties. Now, one, two, or none of those could be done, right? They're not completed deals, but what we were hoping to convey to the market is that is our focus, and we want to accelerate that timeline such that we can bring forward when that dividend could occur.
Okay, fair enough. You mentioned we touched on a dual listing, but you didn't sort of go into great detail. Is that still in your plans?
I think it's something we're always going to be evaluating. What we don't want to do is layer in sort of regulatory hurdles and additional costs with no clear benefit to shareholders. Because what we want to have is the people that hold shares in Trident today, if we do a dual listing, that we get a flood of incoming investors from that new jurisdiction, and that's going to lift the share price. So it has to be accretive at the end of the day. So it's something that's sort of continually evaluated. It's not something we're going to do sort of in the immediate term, but I think when you're at that position where you've got some lower cost leverage, you've commenced a dividend, I think you can go on to a new exchange, the TSX or the New York exchange, and you can do so making a splash by being a good dividend paying royalty company with a broadly diversified portfolio. So we're not quite there yet, but it is something that we're always going to be looking at.
Fine. So your plan going forward in terms of your acquisitions, how do you choose? Are you following the market, or are there other parameters that you use in terms of what you decide to purchase?
Yeah, so it's we've got this mandate to be broadly diversified. That said, we're not turning away good deals because of the particular commodity focus. At the moment, the most accretive deals are the deals that we're looking to do, and as we grow out, we may then start to tailor how much exposure we have to precious metals, say, versus base metals. But we're not obsessing about that at the moment. It's just the best deals and the closest to cash flow are probably the two criteria that we're benchmarking against when we're stacking up opportunities. So we're not trying to get too fancy in that regard. At the moment, it's just what are the best deals that we can do that are going to help us achieve our goals.
Okay, and obviously the talk of the town is obviously carbon neutral for everybody. Is there any particular areas that you're focusing on at the moment which would obviously enhance your portfolio?
Yeah, no, I think so, and I think you can probably get a flavor of that from the deals we've done. So we don't do
Mm.
thermal coal. We're very clear about that. Both because uh, it's not purely altruistic reasons. I mean, there's also large pools of capital that cannot do coal exposure, and we don't want to close ourselves off to that. So for a multitude of reasons, we don't do thermal coal. But it's assets like Thacker Pass that provide exposure to lithium, as I mentioned, sort of a key battery element. We did a lot of work as we did the transaction, on battery chemistries, which ones are most impacted. Lithium is about 10% of the cost of the battery. It's extremely hard to engineer out. It's about 10% of the makeup of every battery chemistry as well, including sort of the future generations of batteries. So it's those really defensive commodities. Then you find a tier one asset, by an operator that's raised 400 million for construction, is clearing its sort of final step towards permit. That's the kind of asset you want exposure to. And similarly, our Mimbula copper royalty. Copper is a really key commodity in global electrification. They just raised 73 million towards expansion of their production. This is a paying royalty. It pays a minimum of 1.5 million this year, a minimum of 2 million next year, although we expect to see it start to exceed the minimums next year as that expansion comes online. And so it's those sorts of assets that you want to get exposure to to good commodities that sort of are critical to this electrification theme, but also over good assets with good management teams, well-funded companies. It's those sort of, if you can marry those two together, and I think we've been able to demonstrate that we're able to do that, that's really what builds a really sound portfolio.
Absolutely, yeah. Okay, and so you're not cash in bank. You don't need to raise further any in the short term.
No, that's right. I'll just jump down briefly to our
Yeah.
capital structure. We've got about 15 million in the bank, and can also use our paper. We've done one deal where it was all for equity, so we didn't eat up any cash at all. And then, as I said, we've drawn our first debt facility, but there's capacity to expand that, particularly if the underlying assets that you're acquiring are cash flowing. Then, debt providers will expand their capital available to us. So yeah, we've got ample capital to deploy to date. We're generating cash as we're paid our quarterly royalty payments. We can expand debt. We can use listed equity. So there's a lot of tools at our disposal, because obviously we don't want to, every time we do a transaction, have to go out there and do a raise against it. We're all equity incentivized, so we want to make sure that we're maximizing the share price as we build the portfolio.
Absolutely, yeah. Then another question that came through was, in terms of your peers or competitors in your neck of the woods, you seem to be striving forward and sort of getting ahead of the game. Is there anybody else in the market in such a strong position as you?
No, I think the challenge a lot of our peers have, and it was a question we got a lot when we listed, because as I said, everybody else is largely precious metals focused. So, and so we were doing something slightly new, which was a little bit, scary initially, that people said, this hasn't really been tried before. How do you know you're going to be successful? And now we've got a bit of a track record, so that question is easier to answer. The problem our peers have is, if gold goes for a tear, you either have to write royalties with sort of really thin return profiles that are exposed to sort of a downtick in price, or you just don't do anything, and nobody wants to invest in a public company that's just sitting there, paying management salaries. You need to be out there growing. And so they've got sort of a tough position. Whereas for us, when we see value in precious metals, we'll take advantage of that. That said, when precious metals run hot, we're happy to pivot to copper, to base metals more broadly, happy to pivot to the battery minerals. We've just got a huge amount of flexibility that our peers don't have. And as we're building up, we're getting kind of more name recognition. I'm calling today from a mining conference here in Colorado and have a full schedule of meetings. So it's, as we're being sort of recognized as a provider of capital, our pipeline is sort of increasingly full, and it's down to the strategy. Our peers aren't doing what we're doing, and there's really not very many that do what we're doing. So we become sort of the sole source of capital in this particular niche.
Okay, and just finally, in terms of the split between institutions and retail, you're happy, that would you like more retail in the index?
Yeah, no, I think we would. I mean, when it's typical of a company when you're this young, sort of IPO'd 14 months ago, you do so with largely institutional support. And then our last raise earlier this year, we brought on a few of the big UK institutions. A couple are just below the 3% threshold, so I can't name them, but you can see Amadi on the screen here, a pretty well-known fund in the UK. So we'd like to see, I think, a greater shift to sort of UK institutions, given we're UK listed. Also want to see more retail get on the register, and that's slowly been happening. We're seeing sort of a reduction in the institutional holdings and increase in retail holdings. We did a primary bid raise alongside our last raise, and it was meant to be open for 4 hours, and we were 4 times oversubscribed in the first 2 hours. So I think that sort of blew our hair back. So I think if and when we do a future raise, we'll be looking to continue to let retail investors participate alongside institutions, because they're a critical part of the capital equation.